Hey everyone, welcome to CoveredCall ETF Investing. I'm Jordan, and this is your central hub for deep CoveredCall ETF data that you can see by this Google Sheet, which is available to all of you in my Patreon, which will be in the description below, or you can get it over here on my homepage. Now, before we talk about price performance with CoveredCall ETFs and really look at how the myths around how CoveredCall ETF prices will fade into oblivion and you'll never see your return on investment, I got evidence to show you that is simply just not the case. So, like I said, before we get into it, a couple of things I wanted to highlight before we start. The first one is, after 10 months, 50 videos and 1,500 subscribers later, I am fully monetized on YouTube, which means at this rate, I'm going to be making probably a few pennies every month, or whatever. So that doesn't obviously happen without your participation, subbing, subscribing, getting notified, and coming back week after week and participating in the comments, asking me questions, reaching out to me through emails, doing one-on-ones. I've had so many with all of you. It's honestly one of the best parts of the channel is being able to do the one-on-ones with you. I tell all of you guys that. But I don't hit this achievement without one particular individual. There's no way I hit 1,500 subscribers, no way I hit the 4,000 watch hours required without a special thanks to the man, you know him, Adriano from Passive Income Investing. The guy who's really inspired many of us to think about financial independence in a different way through these high-yielding income products. When I first discovered Adriano, I just immersed myself in all of his content. Just what I did was took him absolutely seriously because I recognized before I found Adriano, I was kind of already on the CoveredCall ETF path. I was kind of meandering, but Adrian really kind of helped set that path straight. Not only that, but Adrian and I have been able to do one-on-ones with each other, posted a couple of those videos. I know some of you have reached out to me to comment to me or have talked to me during our one-on-ones to say that, you know, you guys have either spoken to Adrian, have had contact with Adrian. He has recommended the videos on this channel, which is like, man, it's so cool to hear that from someone as influential as Adriano to recognize like, hey, this is a dude in the space that takes it seriously and has something to offer, something to provide of value. So thank you, Adriano, for that. And, I'm sure we will continue to converse and have one-on-ones in the future and all that good stuff. So let's actually get into today's video, which is, actually, you know what? Before we start, as a primer for this video, related to price growth and showing what a portfolio does with 100% CoveredCall ETF strategy, what I decided to do back in November was I would start doing these kind of weekly portfolio performance posts. And this was an easy way for me just to be really transparent with all of you week over week. You can actually track my portfolio. You can just go through the community tab. How is my portfolio growing over time? Just on a price performance level, on a total return level. Of late, the total return aspect on Wealthsimple is not accurate enough, so I'm not posting the total return, but I'll continue to post at least the price performance stuff. I'm looking for a total return alternative that I can post in the community tab. I haven't quite found it yet. But the point is, I figured I would need to do something like this for probably a couple of years to really show, hey, this strategy, at least my strategy of being yield focused, leaning growth, actually has legitimacy to it, because to me, I want to be able to have a portfolio. I don't have to whittle away the principal. I could live off the distributions that are provided by and get, as a bonus, ideally, get stability on a price performance basis, get some growth on a price performance basis. So that is my pursuit, is to how do I maximize the portfolio enough that I can get some really good growth and still be within a yield range of probably 10 to 12%, I would imagine. Not to say you couldn't maybe get more, but right now that's kind of what I'm looking at is 10 to 12%. I believe I might be slightly above. My average yield might be above 12% currently. Okay, so I figured I need to do this for about 3 years to really show, hey guys, look, this is the evidence. But here's the thing. I don't need a couple years to answer that question. I already have the answer. And I'm going to expose that data to you guys. This is something I've posted in the passive income investing Facebook group. I've posted on my Patreon. Figured it was worthy enough to do a video on. Okay, I know I'm still going to do the portfolio posts every week just so that you guys keep up with the portfolio. I don't want to dedicate one video once a month, maybe once a quarter to doing sort of a health report of my whole portfolio. But I only do 4 videos a month currently, especially with kids and life and work and all that other stuff. So that's only something I can commit to for now. So let's go into the CoveredCall ETF tracker and let's actually get our answer. So we'll go over to the performance section. You'll see up here, if you don't know, PP is just price performance. And there's these little notes that if you hover over, you can see what it is. Price performance plus dividend is just essentially total return. It's the price performance and dividends combined. So you get the performance of both. But what we're really just concerned with, and I know many of you are concerned with, if I invest in these products, can my portfolio be stable enough that I can just live off the dividends? Okay? Now, if you're like me, I just reinvest everything. But the big question is, for the long term, eventually down the road, I'm not always going to be 34. One day, I'm going to be 64, 74, 84. And if I'm still into all this stuff, God willing, I'm alive that long, then I want to know definitely, can the CoveredCall ETF strategy provide for me in retirement, and when I'm most likely not reinvesting as much, or potentially maybe not at all. I would always like to reinvest, wouldn't we all? But for argument's sake, for the purpose of this video, if I'm not reinvesting anything, what would the price performance look like? So let's go through the average price performance over the last 6 months. You'll see a combination of red. You'll see a combination of green. Let's actually get an average. If you had all of these funds equal weight, what would the average price performance be? Well, over the last 6 months, if you held every Canadian fund, that means every .U fund, every .B fund, you would have a performance of, if you can't see it, or for some reason the screen kind of cuts off down here at the bottom, you're up 0.5%. Sounds pretty good. I like that. We'll do year to date, even though making this video, this is early February, we'll still do it anyway. So we're up on 6 months with a stable price or a stable percentage at 0.5%. With year to date, you're up 0.44%. Now we'll try 1 year price performance. Now, price performance wise, over 1 year, you're up 3.27%. Now let's look at 3 years. What do we got for 3 years coming in at? Are we positive, negative? We are up over 3 years at positive 5.39%. Now we'll do 5 years. There's these funds that have been around for 5 years, not too many of them. Past that, there may be a couple of CI funds, maybe some BMO funds, but it gets pretty... Anyway, I don't even have a column for 5 years. So over 5 years, price performance wise, no dividends included, up 6.09%. So what is the trend line that we see price performance wise? They're all up. There was no scenario where this stuff was down. None. So I built this tracker to answer questions like this, to discover, well, not just answer, but discover questions like these and see for ourselves, is this possible? Can we do it? The evidence is showing me we can do it. Can we get more price performance out of our funds? Remember, this is just an average across every Canadian fund. You start concentrating, you're not going to have necessarily, well, I would say you're most likely not going to have, 80 funds. You're going to have like 10, 15 maybe, but you'll mix them up enough so you're diversified across fund managers. You're obviously diversified across active versus passive strategies potentially. And the number of holdings that it has, some have 20, some have 500, some have 100. Right. The point is, we can see that at a bare minimum, we can at least get these funds to be stable with a little bit of growth over time. If you concentrate down even further into funds like, say, tech, there's probably a good chance that you will get outsized price performance. And you know what? Let's do that actually as an example. What it would look like. I didn't really actually plan to include this in the video, but I think it would be a really good idea. We'll go over to fund category here. And what we're going to be doing is clearing out everything. And let's go to tech, because in my mind, tech is going to be the big growth driver and the staple in your portfolio. So if we go over to price performance, let's check this out. If you have, say more tech in your portfolio, this is the kind of performance that you could, I would say potentially get. Who knows what the future holds, but this is what you could have gotten. I think that's probably better language. What you could have gotten over the past year, 6 months, year to date, 3 years. Let's go over it. Tech, this is what tech has done. Over the past 6 months, you would have gotten 5.83%. Over the past year to date, which is early February, 1.97%. But as we start zooming out over the long term, look at this 1 year. The CoveredCall funds, on average, 36.31%. That's incredible. That's amazing. You're getting the best of both worlds. You're getting high yield with 10% plus amazing capital appreciation. Look at this over a 3-year period, 19.62%. Okay, let's do 5 years. You get 59.88%. If you would have been reinvesting those dividends over that period of time, you're looking at over 5 years, 118.21%. Which, of course, at any time you want to stop the drip and just start collecting income, you can do that. Maybe prices are just too high. You're like, I'm just going to take the cash, invest in some other stuff. Well, you could do that too. Let's check out 3-year total return, 43.51%. So anyway, the point is you're getting awesome growth out of this. Okay, so now that we've looked at all that, I wanted to actually show some examples of funds that have that are, I would say, growth leaning. And I gave you an example with tech as kind of being the biggest funds that I think have that ability to grow over time, price wise. You can reinvest and you'll do gangbusters as well. But let's also go look over at Hamilton. Hamilton just came out with some new funds, and I noticed something that I wonder, and throw down in the comments if you notice this as well. Now, I gotta say before we review, we're not gonna review every fund, it's just gonna be a couple of notable things in each of these funds. But it is of my mind, and has been of a long time, that the Canadian market is really fertile ground for CoveredCall ETFs. Why? I don't mean that in the sense of like it's better than the US for liquidity and all this other kind of stuff. No. I mean, our economy is obviously very different from the American economy, and the sectors that seem to benefit the most from CoveredCall ETFs are things like energy, financials, utilities. These are not, in my mind, very super growth oriented sectors here in Canada. Oil has been essentially trading, if you averaged it out, it'd be trading at the same price over the last 20 years. Okay. So energy for me, probably not going to grow. Financials, maybe it goes, but when we're talking about banks and things like that, does it really grow? Maybe not. It certainly won't, probably most likely won't grow as much as tech like we've seen. And utilities probably just going to be steady Eddie. So for me, if I'm investing in Canada, it's not for growth. It's mainly for pure stability and income. And so over the next I would say over the next year and a bit, my TFSA, I've already determined it's going to be basically all US stuff, US and global. Whereas my non-registered account, to take advantage of taxes and be as tax efficient as possible, will just be those pure Canadian income plays. So let me show you how Hamilton's, especially their newer funds, are starting to. I think they recognize this themselves. They probably have known this for a long time, but I want to show you guys that what I mean. Hamilton already knows this. So HMAX Financials, Canadian Financials, CoveredCall ETF. Let's look at their primary strategy. 50% coverage on the portfolio at the money. So again, that's fairly aggressive. It allows 50% to grow. But financials in Canada, is it really going to grow? Probably it could. Never say never. But to me, this is just pure income. I don't think financials is going to do all that much. Knock on wood. Then we got UMAX, Utilities, Canadian Utilities Maximizer ETF. Again, similar strategy. All Canadian, 50% at the money. They're maximizing income here in Canada. Next up, we got H-Bond. Now, this came out a couple months ago. This is U.S. focused, U.S. treasuries and fixed income with bonds, 50% at the money. But there now becomes a divergence. Now when we get into equities, for all the rest of these, SMAX, what are you going to see? The strategy has changed. 30% with 70% potential growth. They highlight that. Potential growth. Okay? If you think that's an outlier, by the way, SMAX is kind of more or less is supposed to mimic the S&P 500 with about, I think it was 20 holdings. Technology, mimicking the NASDAQ 100. What do we got again? Primary strategy, 30% coverage, 70% potential growth. Okay. And the new ones, U.S. financials. Not just simply U.S. banks, but U.S. financials. So you're getting the credit card companies and Berkshire and a bunch of other good stuff in there. Asset managers, again, 30% coverage, 70% potential growth. And it's like that for all of them. Healthcare is no different. Primary strategy, no different. Now, what will be kind of interesting to watch over time is this new energy ETF by Hamilton, which again, 30% coverage on the portfolio, 70% growth. So this will be pretty different from the king, I would say, of the covered call space with ENCC. There's no other energy fund, in my opinion, that comes close in the pure covered call ETF space than ENCC. But this will offer something different. Instead of being Canadian focused, again, this I believe is 25% Canadian, 75% US, and oil producers just across North America. So interesting to see how price-wise how it grows and against ENCC. Can this become a serious competitor to ENCC? We'll certainly see, because they're going to be offering two different characteristics. One is massive income, especially with ENCL with the leverage component. This offering 30% coverage, with potential growth over time. ENCC, for those who don't know, has 50% coverage, and it's out of the money, I believe. And they don't necessarily write it on all 50%, which is cool. You can check that out on the Horizons ETF website. You can actually see how much of the portfolio they've written it on for that month. So again, all of these interesting to watch, and it is cool to see that Hamilton, based on geography and where these countries are located, that in my mind as well, I totally agree with this strategy. 30% coverage, 70% growth. If we're investing in the U.S., I think there's just a better potential to gain from price appreciation. Whereas here in Canada, I'm less sanguine about that. So I think you get more of the income play here in Canada, and that's how I would diverge the two. Income play in Canada, US, you can certainly go for more growth. So if you're in the tracker, you can certainly definitely filter by US and Canada, although you will get some Canadian funds that trade in US dollars, but that's something you can do and pick up in my Patreon for 13 bucks a month. So, hey everyone, once again, thank you for checking out this video. Hopefully it was informative, and I will see you all in the next video.